Hey guys, it's David. Today I'm going to walk through different property types and their different risk and reward profiles. So let's jump right in. First of all, I've got my chart up here just showing higher risk and more reward as we go up my chart. Um, what I want to point out is that every different property type and the different subtypes all have different characteristics and they affect the different risk and the different reward profiles of all these property types. You've probably drone through town and looked at all the different property types your entire life and may never have thought it in this way. And perhaps that by the end of this video, you will look at your town, your city, your neighborhood in a very different way and realize that there's a reason why certain properties are located in certain places and built to a different size and different temperament and appear at different times in an economic cycle. So let's start with the lowest risk in some cases, the lowest reward would be a triple net lease property. A triple net lease property is typically a single tenant property in a standalone building that has very little moving parts. The tenants are typically there for a long time and they don't move. So that's why that's at one end of the spectrum. The other end of the spectrum, as you come all the way up here, would be a hotel or even a resort. And we're going to go through these in a little bit more. So let's take a deeper dive. The reason they have different risk profiles is because of these four and a few other different reasons. One would be lease term. Number two would be the number of tenants that are typically in each property. Number three, the operational intensity. How business intensive is it to operate each of these property types? And their durability. What I mean by this is their economic durability. So we're going to try to apply these four and maybe a few others to each of the different asset types and take a look at why they are placed on this spectrum in their particular way. If you want, we're going to go in depth a little bit here, but if you want to see more about this, and I do think this is incredibly important as you begin creating your own real estate strategy and begin going out there and buying property, you can always go to beyourownmogul.com. And I teach a masterclass where I'm going to go into depth into all the subtypes and to explore many more different reasons of why this occurs. Let's continue. So triple net lease property. Then there is self-storage. So self-storage typically is signed for a couple of years, maybe 1, 2, or 3 years. Very few moving parts. Once I rent that self-storage, you don't need to get me utilities. You don't need to cater to me. You don't need to provide me very many services. It's very often self-service. I just go in and out on my own. And if I'm putting all of my stuff into this self-storage unit, I'm not very likely to want to move my stuff again. So you can change the price. The economy can go up and down. I'm probably not moving my self-storage stuff very often. Multifamily, again, a 1 to 2 year lease. Typically 1 year. When I lived in Manhattan, some other big cities, they have a 2-year lease. But generally, it's not going to be any longer than that. And again, limited type of tenancy that's going to move out. We say that multifamily is very resilient. Why? I'm not going to go homeless. I'm going to do everything I can to make sure I stay in an apartment. Now, I may go from an ultra luxury apartment to a less luxurious apartment, what we often call A class to B class type of properties. So in a down economy, somebody may move from their luxury A class apartment to a B class apartment, but they're going to do everything in their power they'll sell their car. They will change their habits of how often they go out on vacation or go out to eat. Though even maybe here's an example where they might end their lease on their self-storage facility before they go from a B class property to a C class property. So even within the different subtypes, or it's not even a subtype, it's still multifamily, but it's a different class type. Even within the different classes, there are different risk and reward profiles. And it's really important that you begin to think like this and understand why properties behave differently in different situations. Going to retail. So retail is something going to be affected by each of these. Typically a longer term tenant, 5 to 7 to 10 years, if not longer. Number of tenants could vary. Obviously, there are some very large retail centers. Then there are some very small strip centers that might be 3, 4, 5 tenants only. Not very operational intensive and can tend to be durable. We'll talk about that in just a sec. Office properties, again, tend to be a 5 or 10 year lease or longer. If a company's moving into a facility, they become branded to that. Their employees know that that's where they work. They probably even moved to that particular part of town to be near the office. So offices are typically very durable because people don't want to move. Companies don't want to move to a different location. But you could begin to see how this would get applied where in an office, in a downturn, companies are going to either reduce the amount of space that they're leasing, or they might be forced to break their lease in total, depending on the economy. Um, so too, there could be a change in the entire segment of the business. So for example, during COVID and now post-COVID, many people have begun working at home, and they're not very quickly running back to the office. Companies have changed their entire policies and their entire operations to work around people that are working remotely. That may or may not change back and go in the other direction where companies are requiring people to come back to the office. It could end up being some kind of a hybrid. Some companies are going to require everybody back in the office. Some companies are going to require part-time in the office, maybe 2 or 3 days in the office and 2 or 3 days at home. Others are going to be completely remote and save on the office expense in total. This is currently, right now, as we begin 2025, impacting a lot of cities and a lot of residential suburban office in a big, big way. And we'll see how it plays out. This happened to retail as well, meaning the durability of the business model of needing to go shopping at a retail center changed with the advent of e-commerce. So Amazon and many other companies and e-commerce in general had a tremendous impact on retail, certainly beginning in the late 2000s all the way through the last 10 years, had a major impact on retail. Many retail centers simply going out of business and just not recovering and being repositioned, right? New buyers, new investors came in to a retail center that failed, and they repurposed that retail center. And we're just now coming out of that, where actually now several retail centers are doing quite well, and the entire segment of retail real estate is doing quite well right now. We'll see if that continues. Office, hotel. Hotels have a lot of, I love the hotel business. I began in the hotel business, but that doesn't mean it's not very risky, and also has a lot of reward. They have very short lease terms, right? A hotel is leasing every unit every night. Now, I know sometimes you're going to say to me, when I go to a hotel, I'm often staying 2 or 3 nights. If I go with my family on vacation, maybe I'm there for a week or two. I get that. But in general, you're still leasing that unit every single night. That takes a tremendous amount of operational intensity. You have to have a well-oiled, well-run machine to, market and advertise and have the sales staff that can lease those units every single night. Not just the leasing and the sales, but also the maintenance and the cleaning. Every unit gets cleaned every day, every night, right? It's often, sometimes you go into hotels nowadays, not sometimes, almost every time you go to a hotel these days, they have a little sign saying, if you care about the environment and don't make us re-wash this towel, perhaps you could use it another night. Perhaps you don't need to have sheets cleaned every night. Now, they sell that in the environmental aspect, and I'm a sucker for that. I care about the environment. I don't want to waste my water. I don't want to waste your water if I don't think my towel needs to be cleaned or my sheets need to be changed. I get that. I'm with you. But I think hotels have jumped on this, not because they have bleeding hearts for the environment, but because it cuts down on some of the operational intensity. If they don't have to clean every unit every night, maybe they clean, I don't know, a third or 2/3, or maybe it's 1/2. I don't even know what the numbers would be on what impact the little signs or the environment has had on hotel operations. But my point would be that hotels are very operational intensity, both on the leasing and on the maintenance. You have to have a very well-tuned, fine-tuned machine to be able to do that. And also on durability. If the economy changes, very often businesses will quickly cut back on business travel. They cut back on business travel, business hotels, your Marriott Courtyards, your extended stay hotels are going to see a dramatic impact. So too, families might cut back on their leisure vacation. They might not even go on vacation. They might not be able to, but they certainly are going to cut back on, maybe they don't go as far. They're going to take a longer distance vacation that was going to require an overnight stay in a hotel. Maybe now they're going to take a day trip so they can come back home and not spend the money on the hotel, or they'll take shorter trips. They're going to go away for 2 weeks. They go away for 2 nights, and that'll be the end. So hotels get impacted by the economy very quickly, and the others as well. So I hope this gives you a deeper understanding of how different property types have different risk and reward profiles, and a couple of the reasons why, and a couple of the criteria that every time you see a property, you could begin thinking why one property in one part of town might be more resilient than another same property in a different part of town or in different economies. And in every time cycle that you could think of the reason the economy is changing, and the economy is changing rapidly now. Even now we're going through the AI phase, right? How is AI going to impact companies? As you read different economic reports about businesses talking about laying off staff or cutting back on staff. How's that going to impact office? If there's less people working, then there's less business travel. How's that going to impact hotels? So everything gets impacted by different changes across multiple different spectrums. It's one reason why being in real estate is so exciting, because it's always changing, it's always moving, there's always something to think about, and it's always creating new opportunities. So one property that is having trouble, or one asset type that is having trouble, means another asset type might be doing well, or that you can step in and buy, for example, an older retail property that was not going to do well in the new economy, and repurpose that to become medical office, right? Or something else. You're seeing this happen, by the way, I'm not just saying it, you're seeing this happen over and over and over again. Right now, today, it's very common. I'm seeing these opportunities almost every week now, where an office is being converted into multifamily. I've been seeing hotels being converted into multifamily, because there's such a need for housing. And as the economy has shifted and people are working remotely, there's less of a need for offices or hotels. So drive through town, you'll begin looking at properties differently. And most importantly, through everything that I teach, through everything that I want to go over with you, I want you to begin thinking about real estate in the right way. You're going to begin thinking about property differently, and that's going to make you a better, a more savvier, and hopefully a more successful investor. Speak to you soon.